Hey everyone, happy Thursday, February 13th. It's about 11:15 in the morning on the West Coast, and it's time for another market update. We know the two main points of data the Fed's paying really close attention to when they make their rate cut decisions is inflation and jobs. And we got a report on both those this week, which is we'll take a closer look at. And then also, Fed Chair Powell did his semi-annual testimony in front of Congress. So a little bit of data came out of that. So let's get right into it. Starting with last Friday, we got the big January BLS jobs report. This is a big one. This is the most important job report we get. And in the past year or two, this has been a bad one for us. And this time it came in mixed. And it was a little bit clouded by some changes in the census. They added some more population into these numbers. So overall, the markets didn't react as much as they would to this report just because it was a little clouded by those census numbers. Keep in mind, again, there's two parts of this BLS jobs report. One is the Business Establishment Survey, the CES, where they take some data and then exploit it out using math and try to come up with these projections. So first part of this was actually good for us. The estimate for seasonally adjusted jobs created was 170,000. It came in 143,000. One part they didn't like, though, they made some revisions to previous 2 months and added 100,000 jobs to those totals. So that's, again, less jobs created, good for us. More jobs created, bad for us. And another part that the markets didn't like out of this part of the report was average hourly earnings almost went up by 0.5%. But one thing that did happen was hours worked went down by 0.1, a tenth of an hour, which doesn't sound like a lot. But when you exploit that out throughout our whole economy and our whole labor force, that's actually quite a bit. So average weekly earnings, our actual take home was only up about 0.18. So still wage inflation is not a good thing. I would view it as a good thing. People should make more money, but the markets view it as the more money we make, the more money we spend, which is inflationary. Next part I wanted to touch upon, there's a little bit of an upward skew to these numbers, especially this business survey. Things to keep in mind. So when they call these businesses and have them fill, or when they have them fill out these surveys, they're trying to look at the birth. One thing they're looking at is birth death model. So they're looking at, new companies starting and how many employees are created, and new or old companies closing and how many employees were lost. And one thing to keep in mind is new companies, businesses that go out of business aren't responding to the survey. So they're not getting a lot of data from those companies. So they're saying all these companies are starting, but we didn't hear about any of these companies closing because those companies closed and they don't care. Another part about this, is larger businesses tend to have someone that can answer these questions and fill out this survey. Where small and mid-sized businesses, they don't have time for that kind of stuff. And that goes in this third point. Businesses have better things to do than answer BLS surveys. So again, these larger businesses, and then down here, businesses that are doing well are the ones that end up filling out these surveys, where smaller and mid-sized businesses and businesses that aren't doing well are not filling out the surveys. So that's why that, there'll be a little bit of upward skew to that survey. But again, the markets are looking at this, so we got to pay close attention to it. The second part we get out of this is the household survey, the CPS. So this is where they actually call people on unemployment, ask them questions, and this is where we get the unemployment number from, the U3. The U3 dropped from 4.1% to 4%. That is because the labor force, went up by about 2.2 million, but jobs created were a little bit more than that. So when they do the math, that made that unemployment rate drop from 4.1 to 4%. Not good for us. We want to see that unemployment ticking up a little bit. That would be something that would cause the Fed to maybe cut rates. Whereas if unemployment's coming down, the Fed can say, hey, we're great. We don't need to change anything. One thing to keep in mind is U3 number. If you haven't looked for a job in 2 weeks, they kick you out of these numbers. So that would make those numbers a little bit lower. This U6 counts everybody that's on unemployment, even if you haven't looked for a job or applied for a job recently, and that number's at 7.5%, which is probably a little bit more accurate where things are at. So overall, mixed reports, but market had some negative reaction, but could have been worse. Especially if that census data hadn't been thrown in there. January CPI, we got this yesterday. This was not a good one for us. Again, not as important as the PCE numbers. That's what the Fed pays closer attention to. But again, this is a report that everybody pays, in the markets look at, Fed looks at, and it came in hotter than expected. Taking a closer look at this one. The headline number, came in at 3%. That was supposed to be about 2.9%. So it jumped back up at the 3% number. Month over month, it went up almost 5%, whereas expectation was supposed to slow to about 0.3%. So, not a good start to this to the inflation data. The other part about it is the core number. Core takes out food and energy. Fed thinks their policies have more control over core, so that's usually what we're paying closer attention to. And this came in above forecast. So this was supposed to come, last month it was 3.2. It was supposed to come down to 3.1. It went up to 3.3. So not good there. Again, we want to see that falling. And then the core CPI month over month was supposed to be about zero point 0.3, came in at 0.4. That's why this number came in, hotter than expected. Because of this inflation data coming out and hotter than expected, as you can see here, the markets now are only pricing in one more Fed rate cut the rest of the year, I believe in October. Right now, there's only a 24% chance that they'll do a second cut. Obviously, that kind of stuff can change, but this kind of inflation data is not what we need because, again, it's showing the Fed that if inflation's going up, they got to be careful. They don't want it to get out of control again. So that means keeping rates where they're at, which is not what we want. And then another thing I want to look at real quick, just to give you an idea, where the markets are looking and what's more important. In the past, let's say over the last 6 months, before recently, the jobs report had been more the market mover. So as you see, this jobs report came out not in our favor, and the U.S. 10 or U.S. Treasury yields, a 10-year Treasury yield jumped quite a bit, but not as much as it jumped when the CPI report came out. So as you can see, the CPI report inflation data has kind of supplanted the jobs data right now as the more important thing that the markets are looking at. So anything inflation related that comes in our favor will be more beneficial, and anything that doesn't come in our favor will do something like this, and you'll see the 10-year yield jump like that. So not good there. January PPI, this is producer inflation. This came out today. This was eased fears a little bit after the CPI. It was a little bit higher than expected. It came out at 0.4% month over month. The core was at 0.3% month over month, which was as estimated. But there were some things that in there that showed some slowing down. So I think healthcare costs, like the cost for physicians, airline costs, things like that. So overall, this is something that the markets actually looked at, even though it went up a little bit, and made them feel better after the CPI number. And we got a little bit of a positive movement today because of it. Next thing, initial jobless claims. These have been really low, still low. Estimate was 215, only came in at 213,000 new claims. So it's, again, as far as the Fed is concerned, our labor market, everybody's doing great. Miscellaneous stuff. So, semi-annually, Fed Chair Powell addresses Congress, and he did so this week. There was talk about inflation. There was talk about a lot of stuff. Not too much market moving stuff. He did talk about the CFP. Both sides politically, we're talking about the CFPB, the Consumer Financial Protection Bureau. There's been some talk about getting rid of that. That's been a point of contention. So all this stuff, like we talked about before, until all these policies, new, President Trump's new economic policies on tariffs, on immigration, things like that, until those settle down, there's gonna be some turbulence in the markets. We're not gonna know quite exactly how tariffs will affect things, but right now things are pretty in flux. So Fed Chair Powell spoke. Markets reacted a little bit, but overall, no one really knows what's to come. So there's not a lot of weight put into that. Where does that leave us? Average 30-year this month or this week jumped up from 7% to 7.04%. So a little bit of an increase. It was actually a little bit higher yesterday, and like I said, we got some movement down after PPI. So above 7, still hanging around that 7 number for a while. Like to see it drop down in the 6s, and if possible, get down to the low 6s. Important dates coming up. Like I said, the most important inflation data is this PCE report on February 28th. And then the Fed's next meeting is March 19th. Right now, I believe when I looked last, it was at 98% chance that they do not do anything, 2% chance that they cut. So right now, everything, all this inflation data, jobs data, all is telling the Fed we don't need to cut rates right now. So not what we want, but we got to keep a close eye on it and see where things go and hang in there. And like we've talked about, lower rates doesn't necessarily mean lower price on the home or lower mortgage payment, especially if the home prices start going up. So something to keep in mind. If anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great week, everybody. Thanks a lot.